Hey, everybody, we are going to talk about high dividend stocks today, specifically one of my favorite companies to follow called EPR Properties. They are the owner of, if you've gone to a water park or a ski resort, they might have been the owner of it. They're an experiential real estate owner. Before we dive in, Tyler Crow is joining me. He knows this company really well also. Please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It is the best way to support this work we're doing on YouTube. Again, that is fool.com/Frankel. So, Tyler, my first reaction when I read EPR's earnings for this quarter, or honestly for any quarter in the past, say like 2 years, is they're doing okay. Nothing necessarily is going wrong. The last thing that I said could have gone wrong was when Regal declared bankruptcy, and that was actually resolved kind of in EPR's favor in a way. They essentially replaced all of their rental income that they were supposed to get from Regal and had a few vacant theaters to sell on the side. So it actually worked out favorably. Since then, they've just kind of been, growing at a single digit rate. For years, it was kind of, in 2021, 2022, it was a little bit tougher to gauge how EPR was doing. In 2020, pretty much no one was paying them rent. So in that 2021 to 2022 period, they were getting a lot of back rent, so it really distorted the numbers. It was really tough to say if it was growing or not, or if they were just getting rent from tenants who hadn't been paying. But here we are a few years later. We're a few years post-pandemic, and now EPR is boring again. And I kind of mean that in a good way. 5% year-over-year growth in FFO. Their revenue was up about 3%. The portfolio didn't really grow at all. So that's just pretty much, your lease escalators baked into the revenue. The company is really being selective in investments right now. They're not making no investments. They deployed about $250 million of capital this year, but it's pretty much like the excess profits from their business. Not like they're not issuing debt. They're not issuing new shares like most real estate companies do. I applaud them for not issuing shares or debt when the cost of capital is terrible. They're selling more properties than they're buying right now. They sold 2 movie theaters in the fourth quarter. They're under contract to sell another 4 right now. Limited debt maturities. It's growing. They're forecasting their funds from operations in 2025 to grow by another 3.5%. They increased the dividend by that same percentage, 3.5%. They're a monthly dividend paying company that pays close to 7%. That's doing okay. How'd I do? What do you think of? Do you kind of agree with all that?
For the most part, I think I do remember one of the times that we discussed this company previously. The thing that stood out to me is, if I remember correctly, this was right around the time of the Regal bankruptcy and things like that. Management seemed to be signaling more growth than I think their balance sheet and their financials kind of suggested they could handle. And it appears that with at least what I saw in the earnings presentations, I haven't read all the way through the transcript and on that end, but the presentation, the financials and things like that, it does appear, as you said, their growth component has slowed down, which I think in my opinion, they very much needed. They needed a time to address debt, use modest cash flows to grow the business rather than trying to issue extra capital either in the form of debt or equity to get anything done, because with a high dividend yield and high interest rates, you couldn't underwrite a deal, I think, with what they had in their current debt load. So I do applaud management for kind of reading the room a little bit better and slowing down its growth, which also kind of puts this in this like very much a turnaround phase kind of story. That some of the strategic goals they're talking about, they still want to reduce their theater portfolio. They still want to reduce their education portfolio. And now there's some properties that they were not just the landlord of, but they actually operated themselves. They're looking to, unwind their positions in wholly operated entities as well. So there's a lot of portfolio shuffling going around. They seem to be maybe getting a little bit of traction with some of these eat and play components like Top Golf. I think it was like The best way to explain it is like Top Golf for go-karts, like the Mario Andretti racing experience or something. I can't admit I've seen one myself, but I think I'm getting relatively close to what it is. So I mean, there are some opportunities, but with so much portfolio shuffling going around, it kind of nets out such that growth is still pretty muted at its current valuation. We'll call it a dividend of 6.5%. Management signal they're looking for about a 3.5% annualized increase, which is 10%. And if you can add the growth and the yield together to get a rough gauge of long-term returns, 10% is fine. And I think the business is priced in a way that it can make an okay return at no growth. And I think that's kind of what investors have to be cognizant of when they're looking at this business is, you know, I wouldn't be banking on a lot of growth or valuation expansion in my investment thesis on this today. I think it's just going to be kind of hanging out right where it is with maybe like, some rent increases to increase its dividend without a lot of like big growth on the portfolio expansion side.
Yeah, I don't think you're going to see a lot of growth here until interest rates come down substantially. Right, that's really what they're waiting for to grow the portfolio. First of all, not just grow the stock price. There's two real ways they could grow. Right, there's issuing debt, which is not favorable to do right now because interest rates are terrible, especially for companies with they're not an A-rated credit REIT. They don't have bad credit, but they're not an A-rated REIT like a Realty Income or something like that. So their cost of capital on the debt side is very high. Their share price is still very depressed because of that movie theater uncertainty. The stock's trading at I think 10 times FFO. They don't really want to issue new shares at this level. So I think when you see interest rates fall significantly, the share price will go up a little bit. The cost of debt would go down. So that's when you're really going to see them step on the gas. Uh, they've really been in zero growth mode for like 5 years now, ever since the start of COVID. And I don't really see that changing until interest rates come down significantly. And what I mean by that is like, at least a full percentage point on the 10-year from here, if not more, before I really see growth accelerating. But like Tyler said, I'm happy with a 10% total return for a company that's treading water with potential long-term upside. It's 6.8% yield as of this morning with the new dividend yield. And, if they're growing at a 3 to 4% rate each year, that's a 10% slightly higher total return. I'm happy with that for a company that's treading water that, there's that movie theater risk that's an overhang, but, you know, if 10% is like the baseline right now, that risk reward makes a lot of sense to me. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investments. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.